Hello and welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer with First Source Bank. And joining me for this special edition is Pam Stearns. Pam heads up our tax department and is a CPA. Pam, in July we had the One Big Beautiful Bill pass, which means some changes to the tax law. Let's talk about how it's impacting individual filers.
Sure. The One Big Beautiful Bill, let me go into a little bit more that about 8 years ago, we had another Tax Cut Job Act that was effective for 2018. And President Trump had signed this bill also, which had some major changes to our individual income tax returns. And back then, the individual provisions were going to sunset or revert back to our 2017 tax law, just adjusted by inflation. But because of the One Big Beautiful Bill, these provisions did not sunset and they were made permanent. So when you see the word permanent in the screens that I'm going to do and also in the bill, that just means that they did not revert back to 2017. And they're only as permanent as what Congress makes them. The next Congress can come in and make changes. So wanted to reference that for the word permanent in the slides. Some of the impact to individual filers are that charitable deductions will not be able to be, for those who don't itemize, will still get $1,000 as single filers and $2,000 for joint filers if they make cash donations to public charities. And this will be starting in 2026. Filers that are able to itemize, we have the state and local tax deduction, or SALT, that was increased to $40,000. And this is available only for the years 2025 to 2029. Phase out starts for those with modified adjusted gross income of $150,000. And if you file joint, you will be limited at $500,000. Charitable contributions have 60% AGI for cash gifts to qualified charities. This was made permanent. So we have been using this law for a couple of years. New to the charitable deductions are that the first 0.5% of your adjusted gross income is not deductible. So, for example, if you had a $200,000 adjusted gross income, the 0.5, it would eliminate $1,000 of your deductions that would not be able to itemize. Miscellaneous itemized deductions have been permanently eliminated. This is such like investment advisory fees and tax preparation cost, which we have for the last 8 years have not been able to use those. A new one is the high income limitation that reduces your total itemized deductions if you are in the 37% tax bracket.
Lots of things to reconsider over the next couple of years as you're doing your taxes. One of the other nice things that was made, quote, permanent was that tax brackets did not rise as they were expected to in 2026.
True. They stayed between the 10% and the 37% and did not go back up to 39.6%.
So we're all a bit appreciative of that at the moment. While you just talked about permanent changes, there's also some temporary changes for individual filers that are impactful over the next couple years. Why don't you talk about those?
That's true. I have a screen that says there's three that I want to talk about that will, again, sunset in the year 2028. Senior bonus deduction, it would provide $6,000 per senior, age 65 and over. And this will phase out if your adjusted gross income reaches $75,000 to $150,000. Your auto loan interest deduction is new. If you purchase a vehicle in those 4 years, that possibly $10,000 of the new vehicle interest might be deductible, but the final assembly has to happen in the United States on this car. And this also will be phased out for modified adjusted gross income reaching $100,000 to $200,000. And thirdly, I'd like to talk about the Trump accounts. This is a new one-time $1,000 contribution for qualifying children born between 2025 and 28. If the parent opens an account, the payment will come from the U.S. Treasury. And these are going to be tax-deferred accounts for children under 18. But so far, we don't have very many details on these. We don't know who can administer them, where they can be opened, but we're told that they're going to be part of U.S. stock fund. So there'll be more information coming on that.
Well, it's nice we give the kids at least an early advantage that most don't get. Pam, the last part I want to talk about is estate and gift tax. That's been a big conversation with clients with the idea that certain things would revert back. What was made permanent as part of the Big Beautiful Bill related to estates?
Yeah, on the estate and gift area, made permanent was that unified federal estate lifetime gift tax exemption and also the generation skipping transfer tax exemption. Had we not had this addressed in the one big beautiful bill, we would have sunset back to $7.2 billion. So given that the current year is 13.99 million, in 2026 it's going to increase to $15 million per individual, or 30 million with if you were married and you filed portability on the first death. And this will continue to be indexed for inflation. One thing not addressed because of the big beautiful bill is the gift tax annual exclusion. I just wanted to say that this is now up to $19,000 to any recipient who wants to give away. They won't have to file a gift tax return, nor will they have to pay gift tax. And this continues to be indexed for inflation.
Obviously, the $15 and $30 million impacts a lot of clients that will not have to worry about estate taxes going forward. So that's good information. Pam, really appreciate you sharing your thoughts today. If you enjoyed the video, I encourage you to share that with friends or family. If you do not currently subscribe to the Market Share, you can do so using the QR code at the end of the video or sending us an email at wealthadvisory@firstsource.com. And as always, we appreciate the opportunity to serve you and your family, and have a great day.